3 stocks to buy in July 2019. Now, this is our favorite series every single month where we go over 3 separate stocks and we discuss reasons as to why it may be a good buy in that month. Now, this month we have 3 stocks that all pay out dividends, and 2 of these stocks we've actually discussed on the channel before, but there is one stock that I have not discussed on the channel before, which I think may have a very high potential for capital appreciation and dividend growth over the coming years. So really to summarize, one stock has lost over 50% of its value recently, which is why I want to look at it again. The second stock I want to discuss is yielding us almost a 7% dividend yield and is continuing to grow their dividend. And the third stock I want to talk about has recently corrected, but has a lot of opportunity here for capital appreciation and dividend growth. And guys, if you're familiar with the channel, you've come across where I talk about analyst ratings and tipranks.com. They're one of the affiliates on the channel. Link is in the description down below. But they currently have a promo running to the end of June. If you're interested in purchasing their premium or their ultimate membership, use promo code POSITIVE2019 down here. And when you check out using that, you'll get 20% off your subscription. Now, of course, they also offer an absolutely free version to use as well if you just want to check out some stuff on their website. So either way, check out their website. Link is in the description down below. Now, getting right into it, our first pick here is a gaming company we've discussed before, and that's Activision Blizzard. Now, Activision Blizzard is actually one of the largest, if not the largest, gaming company in the entire world. They currently have a market cap of around $35 billion compared to its closest rivals, EA with $29 billion and Take-Two with $13 billion. However, when comparing their performance the last 1 year, Activision Blizzard is actually the worst performer, but this is where I believe the opportunity lies. The company is really made up of 3 sub-companies, if you will: Activision, Blizzard, and King Digital. And from the most recent quarter, you can see how each segment contributed to the company overall and led to their success here. And each of these companies also has a very popular title behind them, titles like Call of Duty, World of Warcraft, and Candy Crush. So their games are very well known in the community, very popular, and bring in tons of cash for this company. Another huge thing about Activision Blizzard is the fact that they pay out a dividend, and a lot of people overlook this dividend. They've also been growing this dividend consecutively over the last 9 years. So the growth rate is more or less around 10% year over year, which is fantastic when looking for a dividend growth company. And although their current starting yield may be very low at less than 1%, which explains why a lot of people overlook this stock, their payout ratio is extremely low as well, meaning they can continue to raise this dividend for the foreseeable future. This potentially could be a very solid dividend stock in the next 5 to 10 years. And for value investors, this company also provides some value in my opinion. If you look at its current PE ratio, trading at around 24, but its forward PE is currently at around 18, which offers incredible value for a company that has still a lot of growth ahead of it. And the reason I say it has a lot of growth is because it's in a very high demand, high growth market. And one of the big reasons is because of esports and the rise of esports. Esports really is a market that's just been taking over the world recently and currently is valued at over $1 billion here in 2019. And in my opinion, I think this will be close to a $5 to $10 billion industry, if not much more, in the next few years. So it's a huge catalyst not only for Activision Blizzard, but for other gaming companies as well. Another big push recently has been these massive tech giants like Apple and Google that have released gaming streaming platforms. So for example, Google Stadia is probably one of the most common ones, more popular ones, and it hasn't fully been released yet, but it is something that's going to be kind of pushed here later this year and into next year. So this is another huge plus for Activision Blizzard because guess what? These platforms are most likely going to support games from manufacturers and developers like Activision Blizzard. People are going to want to play Call of Duty on there, World of Warcraft on there. So Google is of course going to support that at some point. If not, one of the other platforms will probably support that. And as a result, Activision Blizzard will have some more success from this because now you don't necessarily need an Xbox or a PlayStation to take advantage of these games. So I've kind of given you here my reasons in a nutshell as to why I am still bullish on Activision Blizzard and why I still think the stock is a great buy here in July 2019. Now let's see if analysts think the same way. So the consensus rating is about 11% from current prices, so there is upside potential here seen across analysts. In my opinion, this is still undervaluing the business and the market for this company, and we could see much higher prices in the coming years. And guys, like I said, if you want to see more insight into analyst ratings or maybe check out your stocks, see what analysts think on your stocks, make sure to check out TipRanks and use that promo code if you sign up, positive 2019, to get 20% off. The offer does expire at the end of June, so you only have a few more days to take advantage of it. Now jumping back to Activision Blizzard, let's kind of close this off here with the charts. So as we can see, I really like that we are consolidating here for the last few months, implying that we may have found a bottom in this stock. And in my opinion, that really makes sense considering we've corrected over 50% in Activision Blizzard since its peak just last year. And when we zoom in on the daily chart, you can see it's trying to break through that 100 moving average, which it rejected a few times. And then once it does break through this, I think the ultimate goal will be to fill that big gap before potentially moving higher. Stocks, remember, don't like gaps, and more often than not, they get filled. And with a company like Activision Blizzard with stock fundamentals that are strong, I believe we will fill this sooner rather than later. Now, if I were to buy Activision Blizzard today or in July 2019, hypothetically, I would not expect huge returns on the stock in the short term. As you can see, it's consolidating here. It's taking its time consolidating. It's kind of find a good bottom here. And when stocks get hit this hard, lose 50% of their value in such a short period of time, it takes time for positive momentum to come back into the stock to push it higher again. So this is really where patience and experience comes in, because if you see these opportunities in great companies, you can build a solid position at incredible low prices over a period of time while investors are still fleeing the stock. I believe if we continue in a healthy market in the next, say, 2 to 3 years or so, Activision Blizzard can easily be over $60 per share, most likely over $70, $75 per share, in my opinion. Okay, now let's move on to our second stock here, which is a high dividend pick. And this company is a very tiny company, only a $300 million market cap, and it goes by the ticker symbol PETS, and that's PetMed Express. So they're America's largest pet pharmacy, and I think this is a market that will not shrink as more and more people become pet owners. Pets are like us, they get sick, hurt, or have allergies, and pet medication is expensive. So PetMed Express is a service that actually provides you access to this medication where you can order it online, have it shipped to your door, and more likely than not, you'll save a considerable amount as opposed to buying it directly from your vet. Recently though, their biggest competitor, Chewy.com, went public, and I believe this is what's contributing to a lot of selling pressure here in PetMed Express. Chewy has a market cap of almost $13 billion, where PetMed Express, like we said, has a market cap of only $300 million. And we're looking at revenue, comparing the two. Chewy pulled in around $3.5 billion in revenue, whereas PetMed Express pulled in around $300 million in revenue. So this means when you're looking at the value of the company, comparing the revenue to its market cap, PetMed Express is trading pretty much at a 1-to-1 ratio, where Chewy is actually trading at 3 times its market cap value versus its revenue income. So in other words, you're really paying a premium here for Chewy. And really what this means as an investor is that you can see that this stock is a stock that investors see growth potential in, and that's what's being priced in right now in Chewy. But with PetMed Express, investors don't really see any sort of growth here, and that's why the stock is valued at what it is right now. Now, if you believe that PetMed Express has growth potential over the next few years to capture more market share, this is a great opportunity. In my opinion, if PetMed Express spends a little bit of money and time revamping their website, kind of making it a lot more user-friendly, they can capture a lot more market share than they have right now. They have the brand behind them. A lot of people have heard about this company, have heard about their commercials. I knew about this company, I don't even live in the United States. And I think they really need to capitalize on that and take advantage of that name. But anyways, another huge reason, like I said, we want to look at this stock this month is because of its massive dividend yield. So the current yield is around 7%, and that's incredibly hard to find in a market like this. And their payout ratio is around 50%, and that kind of tells us that it's still sustainable moving forward. And honestly, they've done an incredible job raising this dividend for the last 9 years with an average payout of around 10%. But you can see here that some years it's grown much more than 10%. So really what you're getting here with PetMed Express is a company that has high dividend growth potential, a high starting yield, and is valued incredibly low with a very low PE ratio. But the question is, if you're investing in this company, what does a stock chart look like? But before we get into that, let's take a look at what analysts think about this stock. So we can see here that this is a very small company, so there's not much coverage, and as a result the consensus is around 3% downside, implying that the stock is pretty much more or less fairly priced here. But again, since PetMed Express is only a $300 million company, many large firms do not have coverage on this stock. So keep that in mind, and as always, take the analyst rating with a grain of salt. Anyway, so now let's get into the charts here. So looking at the screen, you see that the stock has corrected over 70% since its peak in 2018. So sentiment here is still fairly negative, which is exactly when I want to start looking into a company and building my position in a company. We are currently at around a 200 moving average on the monthly, which is what I've been waiting for since my last video on PetMed Express, and I do suspect the stock will actually spend a few weeks around this level and eventually find support here. From a fundamental standpoint, they are still growing, they are still operating at a profit, they have no debt, and they pay out a handsome dividend. And I also think that PetMed Express is a potential acquisition play, with Amazon being a very strong contender as the acquirer. Amazon recently purchased PillPack, which is a company that delivers medication to your door, but for humans. Well, in my opinion, the next logical step would be to do the exact same thing, but for pets. And since they already have this delivery logistics kind of figured out, it would be very easy for them to acquire a company like PetMed Express, who kind of has cataloged all of this stuff, has figured out a way to do this, and just integrate that into their whole PillPack system. Maybe they could call it PillPack for pets or something like that. And of course, because of PetMed Express's low value of $300 million, Amazon could even pay, say, 3 times the value of this, maybe $1 billion for this company, and still profit immensely over the long term with this. So just keep that in mind. I think that's another potential here for this company. Now, just like Activision Blizzard, I don't think that PetMed Express is going to have a quick recovery anytime soon. It's probably going to be a slow ride back up, maybe around $20, $30 per share. But the huge benefit here is that you're getting a massive dividend yield, a growing dividend yield, as you continue to hold this stock. So if this company continues growing their dividend at a 10% clip, and you hypothetically buy today with a 7% starting yield, in less than 5 years, you can be earning 10% yearly on your investment. And in 30 years, if you hold this until retirement, you could be earning over 100% on your principal amount every single year just from dividends. And this is of course assuming the stock price stays consistent at $15.50 over this time period, which I think is very unrealistic, and I think that we will most likely be higher in 30 years than we are today. So as you can see, the upside here in the stock severely outweighs the downside in my opinion, but I still wouldn't be putting all of my eggs in one basket here. This is a very small company with a very small market cap, and as a result, it can be very volatile, and we can have wild swings in the stock, which a lot of investors may not be prepared for. I personally would only put a very small portion of my portfolio into this company, just to have some exposure, just to have that dividend income coming in, but I would not necessarily go in and put in, say, 20, 30, 50% of my portfolio in this stock. But that's just how I would do it. That's just my opinion on the stock. You guys, of course, are free to do whatever you want with it. Let me know in the comment section down below what you decide. Okay, now let's get into our third pick, which is a brand new company that we've never discussed on the channel before. I think this is a very fitting company for the summertime, which is why I wanted to include it. And of course, it's at a very good value right now, in my opinion, which is of course why I want to talk about it. So let's just picture this. You're out there enjoying the sun on a weekend, playing some sports maybe outside, having fun with the kids, and hunger strikes and you want to have some quality barbecue food without breaking the bank. Insert Texas Roadhouse, a restaurant that promises to deliver quality barbecue foods like steak and ribs at a price that is extremely competitive and reasonable. You can get steaks here ranging from $10 to $30, and they are good quality steaks from what I've heard. I've currently never been to a location personally because they currently operate in the United States only, but from what I see online, there is a lot of positive sentiment around this company. But from what I see online, there's a lot of positive reviews and positive things people have to say about this company. Their restaurants have thousands of reviews on Google, and the lowest rating I saw from the few restaurants I looked at was a 4.3 out of 5, which is extremely good really for any restaurant out there. Clearly people love the food and the prices that they offer, and I think this is a chain that can continue doing well no matter how the economy does in the next few years or so. And I think this may actually be a good stock to hold during a potential recession as well, because even when times are tough, people are going through a recession, they might not have as much money to spend, they still want to go and treat themselves once in a while, but they don't want to break the bank, and that's exactly what a company like Texas Roadhouse offers them. Now the stock currently trades at a pretty reasonable PE of around 24.5 with a 4 PE of 21. But the best part here about this company is that the dividend potential and the dividend growth potential is huge. Usually for dividend growth stocks, the first thing I look at is the dividend growth potential. I don't really care at all about capital appreciation. But when a company like this, which is still growing rapidly and growing their dividend rapidly, you can actually benefit from both the capital appreciation and the dividend growth. Their current yield is around 2.29%, and they pay out around 45% of their earnings, so this is still very sustainable. Now looking at their dividend growth here, you can see some fantastic stats. They have been growing 8 years in a row with an average growth rate of 15% year over year, which is one of the higher dividend growth stocks that I've come across, while having a sustainable growing dividend. And if they continue growing at this rate, you can see that within 30 years, you can earn 100% of your principal yearly just from dividend income. So like I said, the dividend growth potential here with this stock is one of the best I've come across. But remember, I said that this also has potential for capital appreciation. Well, analysts here also seem to agree. You can see that we have a current consensus of around 16% upside, so it's a very positive sentiment here still surrounding this stock. And guys, again, if you like the information here from TipRanks, make sure to check them out. Make sure you use our coupon code to save 20%, and make sure to let me know down below if you do end up signing up for TipRanks. You can always cancel this membership within 30 days for a full refund, so it's worth a try if you haven't given it a shot already. I personally use it and I absolutely love this service. But anyways, let's kind of close off this month's video here by looking at Texas Roadhouse's charts. As you can see here, we're currently sitting on our 200 moving average on our weekly, which is showing to be some strong support for this stock. We've been hovering here for the last few weeks, and if we hold this, I think the stock could go back to $60 per share or higher in short order. The peak for the stock was around $75, so we still have a ways to go to make new all-time highs. But like I said, based on how much customers love this company, and this is evident through the reviews left online, I think we see $75 fairly soon in the stock, maybe even within the next year or so. And because it's still a fairly small company, just a few $1 billion market cap, it can grow very rapidly, and this could actually become a 10-bagger stock over the long term. But anyways guys, all three of these companies are just my thoughts on these stocks. Remember, I'm a long-term investor. I'm looking for companies that I can hold for 2, 3, 4, 5 years, even longer, maybe even forever if possible. So that's kind of my mindset when looking at these companies. I'm not looking to get in and out of these stocks in a week, in a month, in a year. So if that's what your motive is here, then these three picks may not be for you. I like all three of these companies because, like I said, they're all three strong dividend stocks, dividend growth stocks, and they offer some good capital appreciation opportunity, which is something I look for when I'm looking for long-term plays. Guys, if you want to see more dividend videos or anything else on this channel, let me know in the comment section down below. Comment down below as well as to which of these three picks was your favorite. I was on vacation the last few weeks, glad to be back now, glad to be making videos again for you guys, and I want some suggestions on what videos you guys want to see. So let me know guys, but either way, thank you for watching. Drop a huge like, don't forget to subscribe if you're new here, and don't forget to invest positive.